Welcome to F4 Corporate and Business Law. In this section, I will go over loan capital. Companies have the implied power to borrow for business purposes. Loan capital is the long-term debt that a company takes on. Examples of long-term loan capital are permanent bank overdrafts, unsecured loans, and loans secured by assets. Debentures. Debentures can form part of a company's loan capital, and it is a form of long-term borrowing. A debenture is a document issued by a company acknowledging its indebtedness, whether charged on the company's assets or not. The main types of debentures are a single debenture, so that would be when a company obtains a secure loan or overdraft facility. Debentures issued as a series and usually registered, so the mortgage is fixed. The debenture stock, which is subscribed to by a large number of lenders, so maybe a very big loan which has a number of parties going into it. The benefits of debentures. Normally, the board does not need to call a general meeting to issue debentures. Debentures carry no voting rights, so they do not dilute the current shareholders' control. Debentures are a tax-efficient source of capital because the interest chargeable can reduce the profits before tax, reducing the tax bill, unlike dividend payments, which come out after the tax profits. They are sometimes cheaper to maintain than share capital, and there is no restrictions on issuing debentures at a discount or on redemption, which you do have when you're issuing shares. The limitations of debentures. So interest must be paid even if the company is not profitable. This doesn't happen when you're paying shareholders. You'll pay them out of the company's profits. There'll be no dividend if the company isn't profitable. Debentures are loan capital, and increasing loan capital increases the company's gearing, and this can affect the share prices. Defaulting on a secured debenture may cause the company to be liquidated or to be put into administration. So debentures versus share capital, we've already touched a little bit on it, but here you can see the main differences between a debenture and a shareholder. The key difference is a shareholder owns the company and can vote at AGMs, so they have more control and input over the affairs of the company than a debenture holder. They also take more risk, and in the scenario of a wind-up are paid after the debenture holders, and there may not be funds left to pay them. Charges. When a loan is taken, the lender often seeks to place a charge over an asset, so they can take the asset if the borrower defaults. There are two main types of charge, fixed and floating. A fixed charge is a legal mortgage on a specific asset. This mortgage stops the company from dealing with the asset without the lender's or the mortgagee's consent. A fixed charge is on a specific identified asset. It is an asset which is intended to be retained permanently in the business. So, for example, over a building or perhaps a factory. The company cannot deal with the asset, i.e. cannot sell the asset while there's a mortgage over it. A floating charge. A floating charge is created on a class of assets, the present ones and the future ones, so the ones that turn over. For example, it could be on stock. These assets will change over time. For example, if we have a floating charge over a wine shop, it could be over their wine stock, which we know is sold, but they get in more. The company can deal with the assets as part of their business, unlike a fixed charge. A floating charge does not attach to an asset until crystallization. Once this occurs, the company can no longer deal freely with the assets. So if we go back to our example of a wine shop, The company can no longer sell wine freely if the crystallization of the floating charge occurs. This crystallization occurs when a company is being liquidated, or the company ceases to carry on business, or perhaps by an event that occurs that is outlined in the original agreement. So if, for example, the original agreement states that crystallization will occur if the company defaults on a loan repayment. The benefits of floating charges is that a wider range of assets can be covered. So you've got your stock, maybe perhaps shorter term assets could also be covered by that floating charge. And the assets can be freely dealt with in the terms of the business until crystallization occurs. The main disadvantages of floating charges are actually for the lender. There is uncertainty of the value of the security until it has crystallized. The floating charge holders have a lower priority for repayment than a fixed charge holder, and this charge may be challenged by a liquidator if it was created within 12 months before winding up of a company. This prevents companies from giving preference to, say, one of its unsecured creditors by giving them some security over the assets by a floating charge. Now, the disadvantage is a partnership cannot create a floating charge. The registration of company charges. The priority of a charge depends if it has been registered. A charge must be registered by either the company or the charge holder, and the company registrar notified within 21 days of its creation. Charges on land must also be registered with the land registry. If the company does not include the charge on its own registry, it doesn't render the charge invalid. But if a charge is not registered, the charge is not valid for the liquidator. The company and its officers who default will be fined, and all funds that are borrowed are immediately repayable.